In this question, we will look at the presentation of debt that's going to be refinanced in our statement of financial position. Assume that Working Moms Limited has a loan that is currently due at year end. The debt is being refinanced with a 5-year loan, and the deal to refinance the debt is signed 2 days after year end. How would the original loan be classified in the year-end statements under IFRS and ASPE? Working Moms Limited presents a classified statement of financial position, meaning that they separate the current and non-current liabilities. All right, so let's start with IFRS. So we know we have a loan that is currently due at year end and is going to be refinanced with a 5-year loan, and the deal to refinance the debt is signed 2 days after year end. So IFRS requires any refinancing agreement must be signed prior to the statement of financial position date to impact classification. So IFRS is very strict. It says, listen, your statement of financial position date, let's assume it's December 31st for argument's sake. At December 31st, was the debt current or non-current? Well, we know it's current because it's due within a year. It's due at year end, so it's obviously current. And so even though we know 2 days after year end that it's going to be refinanced with a 5-year loan, it doesn't matter. At the state of financial position date, December 31st, the debt was current, therefore it must be classified as current. Okay, so IFRS is going to equal current. Okay, now ASPE is more lenient. So ASPE says, well, we can consider up until the date of the financial statements being completed if the debt was current or non-current. So ASPE allows us to have this hindsight view up until the date that the financial statements are completed. So in this case, we know 2 days later that the debt's going to be classified with a 5-year loan. So ASPE would say, because the debt was refinanced before the financial statements were complete or issued, the debt can be considered long-term because there is now a 5-year refinancing agreement in place. So ASPE would say the debt is long-term. So there's an important difference in terms of the classification of debt or any sort of note payable or bond payable between IFRS and ASPE. So IFRS says, listen, at the date of the financial position, was it current or not? And if it was current, it's current. It doesn't matter what happened after that date. Whereas ASPE says, well, we'll think about it. If the financial statements haven't been complete, they haven't been issued yet, then we can consider if that debt really is going to be current or non-current. And the reason why is because we're classifying it as current or non-current to represent whether or not that debt's going to require to be settled out of our current assets. So ASPE would say, well, we know that that debt's not going to require settlement from current assets because it's being refinanced to year end. So we will record it as long-term. Whereas IFRS just simply says, listen, the date of the financial position is the cutoff, and that's it. Hopefully that makes sense. And this could potentially be an exam question. So it's definitely something that you want to understand.